Okay, so our topic for today is the week 7 in your LMS, which is the concept of income part 2. So we are going to discuss here about the computation of the gross taxable income and even the inclusions of the gross taxable income when it comes to the business income and profession and the passive and capital gains which is subject to final tax. Okay? And also, we are going to discuss the exclusions from the gross taxable income, or shall we say, non-taxable incomes, which is not included to the gross taxable income. Okay, so our learning objectives here is to classify the income from profession and business subject to tax, to explain the capital gain tax, to explain the income subject to final tax, and of course, to identify the exclusion from the gross income. Okay, so this is only a reiteration of what we discussed in the previous session. So what is the business, or what is the business income or profession? When you say business income, this is the income earned from the normal operation of the business, from the sale of products and sale of services. While the profession income, these are the income earned from the exercise of a profession. When we say gross income, those are the total income of the business and profession before the allowable deductions and personal exemptions. That we call it as gross income, or shall we say the gross taxable income. And part of the business income are also the rent. Okay, the rent income received by a person in the real estate business. Okay, so because we are imparting here that the rent income as subject also to business income, and what is the tax treatment for those rent income subject to tax. And please take note that the tax at progressive rates, because regardless if the basic tax is individuals and corporations, the basis of the taxable income is the net taxable income or for the business, or the net income of a professional, because there is an allowable deductions and exemptions. Okay, so on the business income, in order to get the taxable income, of course, we need to get the net taxable income. So to get for the net taxable income, or net business income rather, is the gross business income for tax purposes less the allowable deductions. And these allowable deductions, it can be the itemized business expense and the optional standard deduction, which is the 40% of the gross income or the gross business income, in order to get the net business income, because the net business income, that is the net taxable income subject to tax, regardless if it is a tax on individuals or tax on corporations. Next is the income of a professional. Of course, in order to get the net income of professional, the gross fees and the gross receipts less allowable deduction, that will be to get the net income before personal exemptions, and then less personal exemptions and net income of a professional. So the taxable base, or the tax basis, is the net taxable income of a professional, or net income, regardless if it is a tax rate on individuals or corporation. But if you talk about income professional, that is also a tax on individuals. So it may be used the normal tax on individuals. But please take note that this is the old regulation, because in the RA 10963, that the personal exemption is no longer applied and it is abolished. So in order to get the net taxable of professional income, is only the gross receipts or gross fees less allowable deductions, and that will be the net income of a professional. But why is it that it is all personal exemption are in there? Because it is a part of your module. At the same time, we have also to discuss the old regulation on when the net income professional to be compute. Okay, but right now the personal exemptions are abolished, so it is not applicable anymore. So under the RA 10963 only the allowable deductions. Okay, regardless, or the allowable deductions are itemized business expense or OSD. So what are the classifications of the gross income from business? Okay, so the classification of the gross income from the business is composed of the nature of the business, okay, like manufacturing, merchandising, servicing, farming, and long-term contract. Okay, so we are going to discuss here how to compute the gross income of the manufacturing and merchandising business, even the servicing, and even the long-term contract as the rent income. Okay, so how do we compute for the gross income of a manufacturing and merchandising firm? So of course, this is basic accounting, a total sales, less the sales returns and allowances and the sales discount, that would be the net sales, and then less the cost of goods sold, and that is the gross profit. And you should add the other income, which is only attached to the major income of the sales. And how to compute for the gross business income for the servicing firm for tax purpose? Okay, the gross income of a servicing firm. Okay, or you have the gross receipts, less returns and allowances and discounts, and less the cost of service. Okay, so that's how we compute for the gross business income for the tax purposes on the services. Okay. So let's have the following illustration. Okay, so in order to compute for the gross income, okay, gross business income rather, ABC General Merchandise provided the following data in its initial operation to determine the gross income for the current year. So we have the following incomes, okay, the sales, the merchandise inventory, and the sales returns and allowances, purchases, sales discount, gains from the sale of scrap materials. Now, what we are going to compute is the gross income of ABC General Merchandise for the current year. So here is the answer. So how do we compute for the gross income? First, we need to get the net sales, okay? So it is an itemized, okay, specified. So the sales minus the sales returns and allowances and sales discount based on the template or the format, that's the net sales. And then to get for the cost of goods sold, the merchandise inventory beginning, since it is zero, only the purchase, and then that's the cost of goods available for sale, and less the merchandise inventory end. So the cost of goods sold is 130,000. So therefore, the cost of goods sold should be deducted to your net sales, and that is the gross profit. And also part of the data or the income of ABC General Merchandise are the gains from the scrap materials, and that's the other income. So it will be added. So the gross income for tax purposes is 75,000. Okay, so that is subject to tax. Okay, before the allowable deductions. So what are the cost of services? The cost of services, this is the allowable deductions from the sale of services of the business. That's why these are the costs and expenses incurred to provide services required to the customers and clients. And what are those costs of service? The salaries, the benefits of employees, consultants, and other experts directly rendering the service. And of course, the cost of facilities directly utilized in providing the service, such as the possession of equipment, rent of equipment, cost of supplies used. And even in the case of the banks, the cost of services shall include also the interest expense. And of course, the rent income is a part of the long-term lease or the long-term contract. Okay, and this is the business income also. So the rent income is the income earned from the lease of the property. It's regardless if it is a real property or a personal property. Please take note that the taxable rent income is aggregated of the following. Say aggregated, it must be included. Okay, So what are the compositions of the rent income subject to tax? The current rental or the lease collection, the advance rental collection or cash advance or security deposits without any form of restriction, and payment of the lessee to the third parties in behalf of the lessor, like the interest expense, the taxes, the loans, insurance premiums, uncollected rent income earned already at the end of the period, and income from the leasehold improvements. So those are the inclusions for the taxable rent income. Okay, so let's have another illustration about the rent income, okay? So Mr. Ruben Padilla leases the 2 rooms of her 3-story commercial building to Ms. Mariel Roges on January 1 of the current taxable year. The lessee, as agreed, shall make the following payments. Okay, so what are those payments? The monthly rental, the security deposits, the 2 months equivalent, the annual real estate tax, and even the annual premium of fire insurance. So what we look for is to determine the gross rent income or the gross taxable rent income based on the following if the advance rent with restriction and advance rent without restriction. Okay, so here are the answers. So to compute for the number 1, advance rent without restrictions, with restrictions rather, please take note the security deposit is not included because based on the rules on the rent income, the inclusions are the security deposits without restrictions. So the only rent income subject to tax or taxable rent income are the monthly rental, the annual real estate tax, and annual premium for insurance, which is the other cost on behalf of the lessor. Okay, so the total rent income is 29,000. And for the number 2 is to compute for the gross income, gross rent income on the advance rent. Advance rent without restrictions. So the security deposit is now included or it should be included to the gross taxable rent income, of course. So the total rent income is 79,000. Okay, so those total rent income are the gross rent income subject to tax before the allowable deductions. Okay, so another part of the rent income is the leasehold improvements, because leasehold improvements is also an inclusions to the rent taxable income. But when you say leasehold improvements, those are the renovation, the improvement, or add additions to the existing properties to improve the current condition of the property to be leased out. So there is a question here. The question here is what is the appropriate tax treatment of the leasehold improvements made by the lessee but subsequently became the property of the lessor at the end of the lease term or lease period? So what will be the appropriate tax treatment for the leasehold improvements? Because the answer based on the National Internal Revenue Code, in the event that the lessee constructed an improvement to the leased property of the lessor, at the such improvements will be acquired or will become the property of the lessor at the time or at the expiration of the lease contract of the lessee and the lessor. And this improvement, it should be recognized as income by the lessor in addition to the annual rent income. I'll repeat. The improvement, it should be recognized as income by the lessor once the improvement made by the lessee at the expiration of the lease contract. But if the lease contract is not expired, so those leasehold improvements, it must not become the property of the lessor. Okay? As an example, based on the other illustrations here, let's say I'm the lessee. I rented a raw land to a lessor. Okay, and then I construct a building, and that is a leasehold improvement. And this improvement is not part of the rent which I paid to the lessor, just only the raw land. But I made a cost. On my part of me, all the improvements is my cost. Okay? As a lessee. Let's say we have our contract for 10 years. And when the contract expires and the building is still on the land of the lessor, so when I left the building, that building which I improved at the time of the expiration of my contract with the lessor, that building will become the property or possessed by the lessor. And this building will be added to the income of the lessor as additional to his annual income, not on my part as a lessee, but part of their ITR which they report, especially if they are paying real estate taxes. Before, I was the one to pay for it, for the estate tax as a lessee for the building, but for the land, it was the lessor. But because the contract was expired, well, both of the real property tax will be shouldered by the lessor at the time of expiration. Why? Please take note, if you talk about the real estate tax, there is a different tax rate on the raw land versus the building. It's a separate computation. Okay? That's under the local government code of when it comes to the real property tax. And real property tax is another story and not part of our topic. I'm just only explaining it. Okay? So that's the answer on that. Okay? So what are the methods of computing income from the leasehold improvements? So we have only two methods to compute for the income that can be added to the and also this is an income from the improvement of the rent, okay, or the lease. So the first one is the outright method. The outright method is a method that the income was recognized based on the fair market value at the date of improvement has been completed. So it's a one-time method that you include the income of lease of improvements to your rent income upon the completion of the improvement. And the basis is the fair market value. The second method is the spread out method. Okay? So how this spread out method recognize the income from the leasehold improvements? First, we have to know the allocated portion of income recognized to each period. And after that, for whatever the book value of the improvement at the end of the lease term, it should be divided on the lease term. After that, the cost of improvement, we have to divide it to the estimated useful life, and that will be the annual depreciation, and it should be multiplied by the lease term, and that will be the accumulated depreciation to be deducted to the cost of improvement. Okay? And this cost of improvement, it should be also deducted or included to the rent income. Okay, so let's have the following illustration here. Mr. Juan de la Cruz rented the vacant lot of Mr. John D for a term of 20 years. The lessee agreed to pay monthly rental of $55,000 in addition to the real property tax of $7,000. Mr. de la Cruz constructed a building on the leased property at a total cost of $5.5 million with an estimated useful life of 50 years without residual value. As part of their agreement, the building will become the property of Mr. D at the expiration of the lease contract. When the building was completed and the contract became effective, the fair market value of the improvement was 7.5 million pesos. Now, let us compute for the gross income from rental of Mr. John D for the taxable year using the following when it comes to the income from the leasehold improvements. First, the outright method, letter A on the date of completion, letter B before the date of completion, and letter C after the date of completion. And the number 2 is to compute the gross income of rental of Mr. John D using the spread out method. But let us discuss how to compute the gross income from the rental of Mr. John D using the outright method. So as per our rule on the outright method, the leasehold improvement must be included to the rental income based on the fair market value at the date of the completion of the improvement. So in letter A, on the date of the improvement, of course, the 7.5 leasehold improvement is included to the rental income, okay, of 1 year, together with the other inclusions like real property tax. So the gross income from the rental is 8,167,000. For the letter B and letter C, letter B is before the completion and letter C is after the completion, the leasehold improvement is not included because as per ruling of the outright, the leasehold improvement must be included to the rental income based on the fair market value at the date of the completion, not before and after. So letter B and letter C, they are both 667,000. When it comes to the gross income from rental, only the rental monthly rental times 12 months in 1 year and the real property tax must be included to the rental income. So the leasehold improvement before and after the completion shall not be included. Only the number 1, which is on the date of the improvement, on the date of the completion of the improvement. Okay, the number 2, let us compute for the gross rental income Mr. John D using the spread out method. So in the spread out method, follow the rules. First, the cost. So what's the cost of the cost of the leasehold improvement? That's 5.5, and we have to divide it on the useful life, which is the 50 years. Okay, the estimated useful life. So 5.5 divided by 50 years, that will be the annual depreciation. And the annual depreciation must be multiplied on the lease term. So the lease term is 20 years. So the accumulated depreciation at the end of the lease term is 2.2 million. And this 2.2 million, it should be deducted to the cost of the leasehold improvement, which is 5.5. So the book value at the end of the lease term, that's what we are looking for, is 3.3 million divided by the lease term of 20 years. So that is the allocated portion of income to the leasehold improvement, because the spread out method is used to include the leasehold improvement only the portion while the improvement is still ongoing or on process. So the 165,000 is the leasehold improvement to be included to the rental income. So the gross income from rental of Mr. John D using the spread out method is 832,000 pesos. So there's another inquiry on the income from the leasehold improvements. What are the appropriate tax procedures if the contract of lease is terminated before the expiration of the lease term? So here are the answers. Okay, the rulings. If the leasehold improvement is destroyed by fire, typhoon, or earthquake, or other similar circumstances, and there is no insurance coverage, so the lessor is entitled to deduct as loss, regardless of the method of leasehold improvement used. Okay, so on the outright, in order to declare the loss is the income on improvement previously recognized less the accumulated depreciation, and that's the book value leasehold improvement. For the spread out method, only the recognized income from the leasehold must be also declared as the loss. The next one, if the leasehold improvement is destroyed by fire, typhoon, earthquake, or other similar inevitable circumstances with an insurance coverage or salvage value, still the lessor is entitled to deduct as loss to the rental income. Okay, about the leasehold improvements, regardless of the method. So for the outright method, of course, for whichever is lower on the term of the lease and under the outright method depreciated over. For the spread out method, the recognized income from the leasehold less salvage value and recoverable amount of insurance, that is the loss on the leasehold improvement. So the leasehold improvement is the life of improvement. Okay, so the number 3, if the lease term has been terminated by the lessor for the valid cause, such as non-payment of the rental income, then if the lease term is terminated by the lessor. Say terminated, the contract was not yet expired but it was terminated early, then that will be the additional income. Okay, the additional income on the part of the lessor to be added to the rental income. So regardless of the method, if it is outright or spread out. So on the outright, the income and improvement previously recognized less the accumulated depreciation, that is the book value on the leasehold improvement. Okay, for whichever is lower on the term of lease and the life of improvement. For the cost of improvement on the spread out method, less the accumulated depreciation and the book value on the threshold improvement, and that is the income. So under the spread out method, the leasehold improvement is depreciated over the life of improvement. So let's have our illustration here again. So Mr. Juan de la Cruz rented the vacant lot of Mr. John D for a term of 20 years. The lessee agreed to pay the monthly rental of 55,000 in addition to the real property tax of 7,000. Mr. de la Cruz constructed a building on the leased property at the total cost of 5.5 million. With an estimated useful life of 50 years without the residual value. As agreed to, the building will become the property of Mr. D at the expiration of the lease contract. When the building was completed and the contract became effective, the fair market value of the improvement was 7.5 million pesos. So let's have the following case. Okay, assume further that the lessor was using an outright method of reporting the leasehold improvement and the improvement was destroyed by fire at the end of 15th year. Also assume that such improvement has no salvage value or insurance coverage. So let us compute for the deductible loss. So what's the answer? So of course, the cost 5.5 million divided by the useful life, which is 50 years. So that's the annual depreciation, 110. And the year of, what's the year of the loss? It should be multiplied by the year of the loss, which is 15 years. That's accumulated depreciation at the end of the lease term. It's 1,650,000. And this 1,650,000 must be deducted to the cost. And this is the book value at the end of the lease term, 3.850. So the deductible loss, which is the book value at the year of loss, is 3,850,000. Next, on the case 2. On the case 2, assume that the lessor was using the spread out method and the building was destroyed by fire at the end of the 15th year with a salvage value of 75,000 and recoverable amount of 175,000 from the insurance company. So let us compute for the deductible loss. Rather, so again, let us compute for the cost, for the book value at the end of the lease term. The cost is 5.5 million. Then less the salvage value. Okay, and that's the depreciable cost, the 5,425,000 divided by the useful life, which is the 50 years. So the annual depreciation is 108,500. And then it was multiplied for the year of loss, which is 15 years. So the accumulated depreciation at the end of the lease term is 1,627,500. And the cost, of course, the cost of 5.5 million it should be deducted to the accumulated depreciation at the end of the lease term. So the book value at the end of the lease term is 3,872,500. And then less the insurance, okay, 175,000. So the deductible loss on the leasehold improvements is 3,697,500. And for the case 3, assume that the lessor was using the spread out method and terminated the lease agreement at the end of the 15th year due to the failure of the lessee to pay the agreed rental fee. So let us compute for the additional income because it was terminated before the expiration of the contract. So first is to compute for the fair market, the income recognized, okay, so the income already recognized. We have to compute it first. So for the income already recognized, the cost is 5.5 million divided by the useful life of 50 years. So the annual depreciation is 110,000. And then multiply by the lease term, 20 years. So the cumulative depreciation at the end of the lease term, that is 2.2 million. Of course, and then the cost of 5.5 million less the 2.2 million, that's the book value at the end of the lease term, 3.3 million, then multiplied by the lease term, divided by the lease term, 20 years. So the allocated portion of income in each period is 165,000. And of course, we have also to multiply on the years used, which is 15 years. Okay. So the income recognized is 2,475,000. So that is the income already recognized above. Okay, above. And after that, let us compute for the fair market value at the year of the pretermination. So the cost again, 5.5 million divided by the 50 years or the useful life, that's 110,000, and multiplied by the year of pretermination, which is 15 years. And then, and that will be the cumulative depreciation, which is 1,650,000, and it should be deducted to the 5.5 million. So the book value at year of pretermination is 3,850,000. Okay, so the 3,850,000 less the income already recognized. So the fair market value at the year of the pretermination less the income already recognized. So the additional income of Mr. John D, okay, upon the pretermination of the contract on the leasehold improvements is 1,375,000. Okay, so that will be the income, or to compute for the gross income on the rent. Okay, on the rent. We are all just computing the gross taxable income on the rent. Okay, before the deductions, before the allowable deductions. Okay, so the next one is the capital gains or capital loss. The capital gain or capital loss, these are the gains from dealings in property. Please take note that this is also an income of the business which is entitled to final tax. But in on the corporation, there are some capital gains which is included to the gross taxable income and subject to basic tax. Okay, so the gains from the dealings in property is composed of sale of assets and exchange of assets. The sale of asset, it can be ordinary and capital assets, and same with the exchange of assets. So how do we determine the gain or the loss from the dealings in property? From the sale of property, the selling price less the cost, that will be the capital gain or loss. The capital gain subject to final tax, or capital loss subject to final tax. For the exchange of property, the fair market value less the cost, that will be the capital gain or loss subject to the final tax. Okay, so how does the capital gain must be treated? So if the asset is ordinary, of course, the ordinary assets, those are the assets used in the business. And for whatever ordinary assets, sale or exchange, that is subject, that capital gain is subject to basic tax. And it should be included to the gross taxable income. But if the asset is capital asset, and these assets are not used in the business, okay, and they are not classified as ordinary assets, okay, that is subject to final tax, which is the capital gain tax, and it should not be included to the gross taxable income. Okay, so the next one are the passive income. So please take note under section 24B, these are the tax rates of passive income subject to tax based on the classification of the taxpayers. First is the winnings, royalties, prices, and other winnings. If you can see from this number one, the basic tax, the basic rate or the normal rate for the passive for the final tax for the resident citizen up to non-resident alien engaged in trading business from letter A to letter F is 20%. From the non-resident alien not engaged in trading business from letter A to letter F, that's 25%. And for the special alien, from letter A up to letter H, that is 15%. But on letter G, okay, the letter G, for the resident citizen, the final tax for the passive income is 7.5%. For the non-resident citizen, exempted because it will be depending on the passive income. It is within the Philippines or not, but it is exempted. For the resident alien, 7.5%. But for the non-resident alien engaged in trade and business and not engaged in trade and business, these are exempted. But for the letter H, for the resident citizen up to the non-resident citizen alien engaged in trade and business, that is exempted. For the non-resident alien not engaged in trade and business, 25%. For the special alien is 15%. But if pre-terminated before the 5th year, the final tax shall be imposed based on the remaining maturity. For 4 years to less than 5 years, okay, that's 5% for the resident citizen up to non-resident alien not engaged in trade and business. 3 years to less than 4 years, okay, for the resident citizen and non-resident alien engaged in trade and business, 12%, and less than 2 years is 20%. And for the non-resident alien not engaged in trade and business, that's 25%. And for the special alien is 15%. Okay, that's the final tax rates on the passive income, or whatever income or passive income will be. And of course, under the section C, the capital gains from the sale of shares of stock, of course, the tax base is the net capital gain. So if it is not more than, if it is less than 100,000, so the rate is 5%, and more than 100,000 is 10% for the resident citizen up to the non-resident alien not engaged in trade and business. But for the special alien, that's 15%. From the capital gain from the sale of property as classified as capital asset, okay, that is 6% from the resident citizen up to the non-resident alien not engaged in trade and business. So the gross selling price or fair market value for whichever is higher multiplied by 6%, but for the special alien, that is 15%. So those are the passive income subject to final tax rates, okay? So of course, under the section 32B of the tax code, there are some incomes, business income, and also the compensation income, which are excluded from the gross income. And what are those incomes which be excluded from the gross income from the business and profession? Of course, as you can see on the exclusion from the gross income, these are the compensation income, which is excluded to the gross taxable income on business, because we already tackled last time about the compensation income, the inclusions, because these things are a compensation income on individuals which cannot be part of the gross income of the business and profession. That's why under the section 32B, they are excluded. Okay, we say excluded, they are non-taxable on the part of the business income, because it is already taxed as compensation income. And what are those exclusions from the gross income? Of course, the life insurance proceeds, okay? These are excluded from the gross income because this is an insurance policy, but please take note that life insurance is taxable if the insured outlives the policy. And even the return of premiums, okay, is also exclusion from the gross income. Gifts, bequests, and devices. Of course, those are the gifts or descent that is it should not be included to the gross taxable income. Even the compensation injuries, especially the compensation for the personal sickness received from the insurance plus the damages. Retirement benefit, of course, and pensions. We already tackled last time that retirement benefit is exempted, okay, exempted to tax for as long as they comply for the Republic Act on the retirement of the old age. But if the retiree is not covered or does not meet the requirements of the retirement due to old age, that will be taxable. the retirement benefit is taxable. Separation pay, of course, the separation pay, it is taxable. Okay, it is taxable if it is voluntary, but we talk about non-taxable, of course, if the separation pay is involuntary due to sickness, physical disability, bankruptcy, that will be excluded from the gross taxable income on business. Okay? Even the other non-taxable income, like prizes and awards given to the religious charitable institutions, and this and the recipient did not join any contest, but the award are only given to him, and the recipient is not required to render substantial future services. What are other non-taxable income? The proceeds or the reward granted to the athletes, especially for those people or athletes who bring honor to the Philippines. They have given a cash proceed, okay, by the Philippine Sports Commission and the Philippine Olympic Committee. So that will be exempted, okay, or that will be non-taxable on the part of the business. Even the benefits received by the person residing in the Philippines, okay? If we talk about individual here, if they are natural citizens of America under the U.S. Veteran Administration, so this kind of pension is not subject to tax in the Philippines. Even the benefits from the SSS and GSIS, okay, they are not taxable, or they are not excluded from the gross taxable income of business. Even the employer's share in the GSIS, SSS, and PhilHealth and other GOCC, government-owned controlled corporations, or any form of contributions. And another, okay, this is for the individuals, the compensation income with the minimum wage earners, including holiday pay, overtime pay, night shift differential, and hazard pay. Okay? And then no bonus. O, take out no bonus. However, this is non-taxable. However, an employee being paid a statutory minimum wage, which is statutory, this is the minimum wage based on the law, statutory benefit of the law, who receives additional compensation such as the commissions, honoraria, benefits in excess of 30,000. Take note, for the additional compensation in excess of 30,000, then that will be taxable. Letter B, who receives other income, such as income from the conduct of trade, business, practice, or profession, except income subject to final tax, it shall enjoy the privilege of being the minimum wage earners, and therefore his entire earnings are no longer exempted from the income tax. So in case that the employee enjoy the minimum wage earners on all the privileges, then that will be taxable. Okay? Even the 13-month pay, only in excess of 82,000 is taxable. And even the benefits given to the rank and file employees granted under the collective bargaining agreement or not, and even the fringe benefit granted to employee which is required by the nature of or necessary to the trade or business profession of the employer. So I would say fringe benefits, okay, that given to the employees, of course, that is subject to tax, but at the expense of the employer, of course, it will as part of the business income, which benefit is not included to the gross taxable income of the business, but taxable income on the part of the individual. Sorry. And even the fringe benefit granted to employee and fringe benefit given to the employee for the convenience of the advantage of the employer. Even the de minimis benefits. So the de minimis benefits, those are the privilege of an employee which are relatively small value. Okay. An example is the entertainment, medical services, and courtesy discounts. And these de minimis benefits are non-taxable, provided that each of the following de minimis benefits from letter A to letter L, if they are exceeding, if the de minimis benefits exceeding beyond on the minimum exemptions, that will be taxable. Okay? So let's have the following illustration here. Mr. Juan de la Cruz, single worker receiving a minimum wage of 491 pesos a day in the National Capital Region. During the month, he receives the minimum wage of 12,766. Okay, 1,000 hazard pay, 5,000 overtime pay, and 2,000 night differential pay. So how much is the amount of the non-taxable income or taxable income of Mr. Juan de la Cruz during this month? So the answer is that all income of Mr. Juan de la Cruz is non-taxable due to the minimum wage earner non-taxable, which all the privileges and benefits shall not exceed 30,000 pesos. Okay, as I mentioned earlier. So that's why all his income is non-taxable. Okay. On the case number 2, okay, Miss Juana Cruz, single, is a sales lady receiving a minimum wage of 491 pesos a day in the National Capital Region. During the month, she receives a 12,766 minimum wage, 5,000 overtime pay, 2,000 transportation allowance, and 6,000 sales commission. So how much is the amount of non-taxable income or taxable income of Miss Cruz during the month? So the answer that all income received of Miss Juana de la Cruz, or Juana Cruz rather, is taxable because based on the minimum wage earner, if they enjoy the privilege and benefit and exceeding 30,000, so that is taxable. And the last one, Mr. Juancho Santos, married, an engineer, receives a basic salary of 55,000 per month. Okay, he received the following income during the year. So Mr. Juancho Santos has the basic salary, the 13-month pay, the productivity bonus, clothing allowances. So the question is, how much is the amount of non-taxable income and taxable income of Mr. Santos during the year? Of course, let us classify the income if it is taxable or non-taxable. Of course, the basic salary, that's the compensation income, so that is taxable. What about the clothing allowance? So the clothing allowance is a non-taxable for this is a de minimis benefits, okay, which is not exceeding 5,000. So that is non-taxable. But on the 30-month pay and other benefits, which is the 30-month, 55,000 and 27,500, so the total of 82,500, only the 500 pesos is taxable and the 82,000 is non-taxable. So therefore, the non-taxable income of Mr. Juancho Santos is 87,000 and the taxable income of Mr. Juancho Santos is 660,500. Okay, so that is our topic for today, and that will end up our topic for today when it comes to the second part of the concept of income.